What's going on, dividend chasers? It's the Dividend Bloodhound here with another investing video, and today we are going to talk about assets versus liabilities. If you like what you see in this video or you're new here, please hit the subscribe button in the corner there. If you've been here before and you like the video, please give that like button a smash. Hit the comment section below with any feedback that you might have, and if you have your own YouTube channel and I'm not already subscribed to you, please let me know that you've subbed my channel in the comments below, and I'll get subbed straight back to your channel. After all, we're all about growing. Right, in this episode we're going to talk about assets versus liabilities. So, an asset is something that will provide you with economic benefit either now or in the future, and it is wholly owned by yourself. A liability is a financial obligation either now or in the future. You are obligated to pay this by a contractual term usually. So, examples of assets and liabilities. We have a very simple one. An asset is a non-mortgaged property or your home, and the liability would be, for most of us, the mortgage that we have against that home. So your liability is your monthly direct debit payment against that property each and every month. For most mortgages are 25 years. Now, a lot of people think that their home is an asset straight away, and that is largely true because you do get your benefit out of living in it, but you are still have the liability to pay the mortgage. Because if you don't pay the mortgage, you're not going to be living there. It's as simple as that. What could be argued as is the asset in that property is the equity that you have within it. So, I don't know, if we use a £200,000 property for an example, your asset essentially would be the £20,000 deposit that you put down against it, and then however many mortgage payments that you've made against it in terms of the capital repayment, obviously not the interest because that's the banks. So I don't know, if you've had the property for 5 years, then you've probably paid a random guess, you've paid £5,000 off it. So your asset there sort of is the £25,000 equity that you've got in it. But if you sold it and paid down the liability, which would be the mortgage, that is yours at the end of it, and that is going to provide you with economic benefit essentially. It's £25,000 to do whatever you want with. Now, it's important to remember that you can, and what a mortgage is a good liability. Liabilities can be good and bad. Assets can be good and bad depending on how you think about it and how your mind works. So, a lot of people would argue that a mortgage is a good liability because it gets you your home, and over the longer term, that home is going to go up in value. The inflation eats away at the mortgage debt, shall we say, so you actually end up better off. Now, a really bad example of a liability is a car loan. Let's just really think about that one for a second. You grab a car, you really like it, you buy it brand new off the forecourt, first driver. I know the feeling of this personally. I bought a new car and fell into this trap. You really like it, first driver, delivery mileage, 4 miles on the clock, brilliant. But as soon as you bought that car and you've gone into the financial agreement that comes with it, if you can cash buy a car there and you've saved up to do that, then that's fine. It becomes an asset immediately. You've used your money, you've bought the car, that is your asset straight away. It's a depreciating asset, so it goes down in value as you put miles on it and as the car gets older, unfortunately. But it is an asset nonetheless, and you could sell that straight off and grab your money straight back, and it does provide you the benefit of getting you to A to B. And the biggest rip-off about car finance is that you're paying a financial agreement that doesn't go down against something that depreciates in value. So you take out, I don't know, a £30,000 debt to get yourself a really nice BMW, Mercedes, whatever you want to call it. That never changes. You take it out over your 4-year term, let's say. Your payments are £500 a month, so you've got to pay your £500. But meanwhile, that car is probably depreciating slightly quicker than you could possibly pay off, even if you were paying £500 a month, especially if you're using it quite a bit in terms of mileage, because that takes value off the car straight away. And even when you buy it and it turns up and it's in the forecourt and it looks absolutely amazing, it's under the cover, you get the big reveal, oh, this is your new car. As soon as you click the key, you get in it, you start the engine and you drive off, you've lost a few £1,000s right there, because now that's yours. As soon as it's got a registration on it, that's yours, and it's not a brand new car anymore. It's devalued. And that is a really bad liability to have. I've learned the hard way with this one. And yes, I do still have a car loan, but it is a reduced car loan now, and I'm working to try and get this paid off, because I just don't want a car loan anymore, because I just view it as a terrible debt. I would rather use the spare money. Obviously you need a car, and I would like a nice car, but I would rather save up the money and go that way rather than pay a loan against it, if you get what I mean. I'm going to work the other way after I've secured this car loan that I've got now. In the future, when I've got family or whatever it is, might be a different story, but for now I'd rather have no car loan and be able to buy a third buy-to-let property, or be able to plough more money into my dividend investing portfolio, or whatever it is that's going to benefit me and not the finance companies, essentially. Now, the last thing that I do want to touch on is what your net worth is. So your net worth is your assets minus your liabilities, fairly obviously. So if you've got equity in your property, or you're lucky enough to own a property outright, you've got your, same example, you've got your £200,000 property, it's all yours, you've paid the mortgage, but you've got a £35,000 car loan because you drive a really good Jaguar or whatever it is, then your net worth, and this is big chunk examples, it would obviously be a bit less than that, and it would be moved around because there'd be other bits and bobs that you've got to add in there. But big chunk examples, you've got your nice £200,000 property there, and let's say you've got £50,000 in the bank. That is also an asset, or £50,000 invested in stocks, shall we say. That would be the dream, wouldn't it? But let's carry on there. So your net assets is £250,000. However, you've got a £35,000 car loan. So your actual net worth is, I can't do the maths, 215,000, there we go. Sorry, a bit slow there. Yeah, so your actual net worth that you could go around if you really wanted to brag about it, not that many people would, but your actual net worth would be £215,000, because you have to take that liability off all the assets that you own. And that sum really for most people would be a lot more complicated than that, because you've probably got your home, you've probably got the property, the furniture inside it, you might own a second car, you got a TV, you've got a mobile phone, computer, all of that sort of thing. And it all depends whether you have a financial agreement against it or not. That's pretty much it. If you have to pay another day for it, that is a liability. It is as simple as that. If you have to pay a direct debit, that is a liability. Now, some you can't avoid. A direct debit for council tax, that's a legal obligation. A direct debit for your TV licence, that's a liability, but it's an obligation. Same with your utility bills. They're all liabilities, but there isn't really anything you can do about that unless you want to live without water and in the dark. Maybe you do. I certainly don't. But them are fixed, non-movable liabilities that you will just have to live with. The big ones to eliminate are the liabilities where it's your choice to be there. You do want to drive the really fancy car, and if that's up to you and you really like cars, that's absolutely fine. I'm not criticising, I'm just saying my personal point of view. Or it's the same thing with credit cards. You've got an extortionate rate of interest, but you really, really want that Louis Vuitton bag, for example, that's £1,500. Now, it all depends on your monthly income, I suppose. I mean, if you're earning £5,000–10,000 a month, absolutely fine, that's not bad at all. If your monthly wage is £1,500 a month or less, Should you really be buying that bag? Should you really get into debt for a month's wages just to buy that bag? I would hedge my bets and say no, but I know that there's a lot of people out there that would plump for it because of the show-off factor. I don't know who they're showing off to, because for the most part nobody is really looking. But that's just my humble opinion. You probably have your own humble opinions, and it's down to you to decide what liabilities you do want to pull up with and take on, and what that you don't, or you can eliminate. I learned the hard way. I had the liability of a car loan against a car that was very nice, very fancy, but ultimately it just burned a hole in my bank account. Simple as that. So I've changed it now for a much more manageable loan until I pay it off, and then I won't have a car loan at all. That's just my opinion, and this is the Dividend Bloodhound out for yet another video. I'll catch you all another day. See you later.